Hello and welcome to Talk Franchise, Home Instead's podcast series aiming to give you an insight into the world of franchising. My name is Luke Spellman, Franchise Development Manager at Home Instead, and today I'm joined by Imogen Clarke, Head of Franchise Development at Home Instead, Marc Talbot and Ines, who are both Franchise Directors in the franchising sector team at HSBC. They are fantastic guests to have because today's episode is all about funding, what you can expect from the funding process, what options are available to you, and ultimately how to fund a franchise. Hello, guys. Thank you very much for joining today. Today we're here to speak about funding, specifically how to fund a franchise and what is involved in that process. Before we begin, can you all quickly introduce yourselves? Amy, we'll start with you.
Yeah, so I'm Imogen, or Imi, and I'm Head of Franchise Development at Home Instead. So alongside Luke and a few other members of the team, we support people in their franchise journey, joining Home Instead via a new business or perhaps a resale as well.
I'm Marc Talbot, Franchise Director for HSBC. I've worked for HSBC for 18 years. That's very much a HSBC thing to do, to say how long you've been working there. But I've been in franchising for the last 5, so I work with brands and franchisees to put finance programs in place for them.
And I'm Ines Laing, Franchise Director also at HSBC, and I manage a portfolio of franchisor brands domiciled in the UK.
Welcome. Thank you, guys. And cheers for joining. I think it'll be a useful one to cover both the franchisor side of the conversation as well as the banks and the actual lending side. So I think we should start broadly with an overview of the lending process. Some people listening and watching at home will know and have experienced this before, but I think a lot of people that are thinking about franchising as their next step in life might not know that this is even an option to them. And if they do know that it's an option, they might not even know how it works. So could we start with a general overview from you guys, please?
Yeah, I think we'll try and not overcomplicate it and, demystify it, because I think people can get quite worked up about this. And there's loads of things that they don't have to worry about that are internal processes that we have to go through. I think the main thing for a franchisee is, select the franchise that you want to work with. Then they'll help you give a clear idea of startup costs. Consider how much you've got to put into that. And then you'll understand how much you need to borrow. I think at that point, then you start to approach the banks. And we try and keep it simple in terms of what we look for is mainly a business plan with financials. So that's, let's not try and overcomplicate this. We're there to support you. Like I said, there's loads of things that happen in the background that franchisees don't need to know or understand.
And Imi, from your perspective, what does it mean to the franchisor? Maybe at what point do people need to think about it?
I think, obviously for funding a business with any franchisor, you want to try and talk about how much you can afford. So being upfront and honest from the beginning with the franchisor, but also the banks. It depends on the prospective franchisee when they want to speak to the bank. Some want to do that right away. That might not be as relevant for you guys because it's so early on. So I'd probably say once you've got an idea of perhaps your top 2 or 3 franchisors that you want to go for, and you are really committed to that process, that's when you'd want to start speaking to the banks.
I think it's really important that the franchisors build the relationships with the banks as well, because you want to be able to make a recommendation to the franchisees for a bank that understands your franchise model and therefore is more likely to get access to finance to help them grow.
Yeah.
I think if franchisees are left to their own devices, the bank may support them on the first project, or the first loan, but do they really understand that franchise model? Can they go on that long-term journey with them? So I think that's what really important for franchisors, to sort of build that.
And I think that's really obvious when you have, because we've had it before where prospective franchisees have come into a bank without our introductions. They've gone perhaps to their local branch instead of us introducing to the franchise team. And their journey has been all over the place, crazy. that team don't understand franchising, and there's a lot of push back and forth. Whereas going through the franchising team, it's such a smooth, seamless process because you guys understand franchising and understand the model.
Yeah, I think that's a really unique thing for HSBC. So our franchise team is whole of sector. So we work with, I think it's over 200 brands in the portfolio.
Over 200, yeah.
Everything from, small startup business all the way through to some of the largest, corporates, multi-unit, multi-brands.
Yeah.
So I think we understand, franchising. We don't just cherry pick a certain brand, a certain franchisee. We try and, be sort of whole of market.
Yeah. So, I mean, it's a really important part of the process for someone looking at a franchising opportunity generally. And so if that relationship is tight, then it's a seamless process, right, throughout the entire thing. So, yeah, that makes complete sense. And is it an option for anyone looking for a franchise?
Yes, yes.
Well,
I think that's the simple answer. I think that's the whole point of franchising. I think there's loads of alternative employment, franchise brands that you see out there, which I think is a really good way for people to to enter franchising. And then there's some obviously larger brands that require more of a business with a more of a sort of management structure that's sort of put in place, and that might not be for everyone. So I think there's a huge amount of opportunity out there in the franchise space. Anyone can approach, a bank for lending. I think, there's a couple of really important things. One, they have to have some cash themselves to put into the business, because 100% finance for a brand new franchise business is kind of unlikely.
Yeah.
They also need to consider credit scoring as well. I think that's one thing that we get asked a lot. Will credit scoring be part of the process? And I think some people think because they're setting up a business that it won't.
Yeah.
But ultimately, you still end up doing credit scoring on the main individuals in that business. So again, I'd encourage someone, if they're concerned about that, there's loads of free apps out there. I'm not going to plug any of them on this podcast, but there's loads of free apps that they can download their sort of credit report and take the steps if there's some issues on there to address it over a period of time, and then they can approach banks and try and get some funding.
I think it's also worth noting that with different franchisors, they've got different funding options with banks.
Yeah.
So, for Home Instead, you need 30% cash. The remaining 70% can be funded by the banks. But there are other franchise brands that will have different percentages, and it's worth knowing that when you're going in. And then there'll be, because I speak to a lot of franchisors, there are a lot smaller financing options where that can be done locally through the funding options that they've got set up as well. So definitely get the franchisor involved and be as open and honest with the banks and the franchisor.
I think that's a really important point. When we onboard a brand as the first time as a franchisor, most of the time we always start at 50-50 funding.
Yeah.
And then over time, as our experience and understanding of that model, we then start to tweak that percentage. So, again, like Imi said, for a brand like Home Instead, we go up to 70% finance, which I think it makes a difference in terms of the people that you can attract, particularly on resales.
Yeah.
That's quite a high, even at 30%, that's quite a high amount of capital required for them. That extra percentage becomes really important.
Yeah, it's an additional selling point.
Yeah.
That actually you've got a stronger opportunities as a result of going with brand A versus brand B.
Yeah, but I mean, equally, even if a brand's at 50-50, it's not necessarily a sort of negative. It just shows where they are in terms of that, cycle.
Yeah.
With the prospective banks.
I think another thing to take into consideration, there are a lot of good points made, but a lot of clients will be able to self-fund or will have the cash resources to self-fund the full startup costs or funding requirement. But there's an advantage to building that relationship with the bank and borrowing some of our money.
I agree. So, because we say the same thing, for somebody that is saying, I'm 100% funding, I'm going to do it myself, we always do say, just be careful, because you've got to save it for a rainy day. You don't know what could come up in your personal life, and fingers crossed nothing's coming up, but you just want that security behind you. And so even if you're thinking 100% is where I want to go, I would still, if it was me, speak to the banks as well to get an idea of what's available there.
Yeah, because I think the bank that you start out on the journey with needs to be the right bank from the start that understands the franchise model.
And so, just thinking about the process, does it look the same for every single type of franchise purchase? So, you've got For people that might know about might not know about the different types, you've got new territory purchases, purchasing an empty territory and building a business from scratch. There's resale opportunities where someone else has built a business for a period of time and there's an existing business up for sale. And then, of course, internally, then there's considerations with multi-unit where people are purchasing additional territories with a brand. Of those three types, does the process look the same or are there slight variations within that?
No, there's absolutely variations in the lending process there. I mean, for example, a new territory, a virgin territory, there's going to be higher startup costs. There may be a deferment before income is generated due to the business being new, and there's going to be a period of time before the invoices are going out the door and the cash cycle is positive. Looking at a resale, you're effectively buying a business which is successfully trading, well, hopefully successfully trading, certainly from a bank's perspective, and where the income is cash generative from day one.
I think there's a consistency though that helps with all the applications, because if it's a home instead, then it's going to have the same look and feel. If it's a new territory, if it's in Stoke-on-Trent versus Warsaw, that business plan and those financials should look broadly similar, albeit there's probably different opportunities in those respective. But what I'm saying is the look and feel should be the same. That's one of the beauties of franchising. I think when it comes to multi-unit, I think there's a lot more financials to consider. Firstly, for the existing operator, we look at the existing business. How's that performing? And we will attribute a lending value to that existing business. Then there's the business that they're buying, and then you've got to understand what is the EBITDA from that business. So again, you might be making some deductions based on the current owner's salary, what they're paying into their pension, all things like that, to try and get it to a point of what will that business look like in the buyer's hands moving forward. So it's a bit more complicated in terms of the financials. But then what we try and do is we apply our 70% to the group, so to the new group. So the EBITDA of existing company plus new, we will attribute a lending value to that group. And then as long as we're at 70%, so that's why sometimes the amount that we can lend is higher on resales for an existing operator.
Right. Okay.
I'm trying not to get too technical and complicated here, but I think it's just to show that I think once you're established in a brand, sometimes the finance can become more flexible and can really help you scale and grow quicker.
Okay. Would you say then, generally speaking, it becomes slightly easier to borrow as you build a multi-unit or an enterprise operation?
Yeah, definitely. And I think we see that as, we've got a lot of clients that go, multi-branded as well. So I think, once you've got that existing business that's performing really well, consistent cash flows, consistent EBITDAs, you can sometimes become restricted in terms of the opportunity. It might be, from the geography, or just, sometimes in terms of your appetite for wanting to grow in that brand in sort of general. That's where then you can start looking to, to diversify into other brands. And that's become really popular over the last few years. Like a lot of the franchisees that I work with are multi-branded.
Mm-hmm. Okay. I mean, it's a slight deviation, but I do think it's important. Why would you say generally that people are thinking about multi-brand opportunities? Is it just an extension of the journey? Like at some point you get to a stage where you think, I've grown in this brand and now I'm ready for something else? Or is it, is it a diversification of, what in your opinion, why?
I think it's a little bit of everything, really. I think there is an element of definitely like diversification comes into it. Yeah. I think, fried chicken presents a great opportunity in the UK. There's loads of brands there, but how many stores would you be able to open in your chosen territory? Mm-hmm. And then if the option becomes, do you move 50, 75 miles up the road into a new territory, or actually are there other opportunities for brands in your territory where really well, you've got some great sites in brand A, you've got some great people, so I think that becomes a consideration. I think sometimes your scale can be limited in a certain brand, and therefore if you've got ambitions to grow, which not everyone has, but a lot of operators have got ambition to scale. Yeah. You then have to look to diversify and you have to look to add more, brands into the portfolio. The other thing as well is that more brands are starting to franchise. So you might have never ever thought about franchising with Pret, for example, and then 3 years ago they launch a franchising model, and that just throws everything up in the air, because that's the kind of brand that a lot of people were attracted to.
Makes sense. Well, no, thank you. And I know that's not necessarily the topic of our conversation, but I do think it's important to kind of throw in. And something that you mentioned as well, which was EBITDA. That's kind of a term really that we all know and use on a daily basis, but I do think a lot of people won't understand that. But it's integral to this. So could you just explain roughly what that is, and not even necessarily on a technical level, but just what is that, and what does that have to do with any of this?
It's effectively, the most simplest way of understanding it is effectively the cash that business is generating. So in there's a couple of non-cash items like depreciation, amortization. So they're accounting terms, and that's a way of treating an asset in the business, but it's not a cash expense. So what we're interested as a bank is how much cash is the business generated to be able to service debt.
Yeah.
And that's why the EBITDA number is really important, from our perspective.
EBITDA, earnings before interest, tax, depreciation and amortization, or potentially earnings before interest, tax and deductible allowances. Us banks love our acronyms, and EBITDA, as everybody's mentioned previously, is used fairly often.
Yeah, I thought that was important to establish, because certainly when I first started in this department at Home Instead, it did take me a little while to get my head around that concept. So thank you guys for explaining that. So we've kind of set the scene really about lending and what it means for people and the opportunity it presents. Can we dive in a little bit on why banks look favourably on franchises? I know we slightly touched on it, but Imi, I'll come to you then and almost ask you the reverse question as well.
So I think as a prospective franchisee, if you're looking at franchisors, the fact that they've got a good relationship with banks is a really good sign of reassurance for you, because it's a third party saying, we trust this brand, we're going to be lending to these prospective franchisees. Yeah. So that is something I would definitely look at if I'm looking for a franchise, and I would be asking the different brands, what are the relationships with the banks like? I'd want to speak to each of them to kind of get their experience on that brand as well. That's what I would be doing if I was in their shoes.
Cool. And from your perspective, why do you as the bank look favourably on franchising as a business model?
Well, franchising is a tried and tested, proven model, and we know as a bank, as a lender, the collaboration that we enjoy with all the brands that we work with. If we lend £1 in the franchise world, the chances of us getting our £1 back are fairly high. And that's a testament to the hard work that the franchisor does in looking after their franchisee clients. Franchising is a proven business concept. Mm-hmm. If you follow the rules, then you will be 99 times out of 100 very, very successful. And it's the failure rate in the franchise sector is far, far lower than in the commercial business space where we operate. And, long-standing relationships with proven franchise brands. And another thing that's huge for me is loyalty. If you work with a franchisee, you're going to be with that person from day one right through to hopefully when they're, picking up the phone and looking for multi-unit. So the word relationship from start to finish is huge, and that's why we look at the sector so favourably.
Yeah, okay, that makes a lot of sense.
I think it's underpinned by, systems and support as well. If you look at, Home Instead's a great example. How many people do you wrap around the franchisees, to help them on that journey? Because starting a business can be really, really difficult and really, really challenging.
Yeah.
And if you're an independent, who do you turn to for that support and guidance? Whereas if you're in a franchise system, the franchisor has experience of probably everything that you're going through. They've seen with another franchisee, especially the amount of franchisees you have in the system. There's probably nothing that you haven't encountered. So when they're going through those challenges, you can help them navigate it in a more positive way.
Yeah.
I think that is huge. I think also the It's really long-term franchising. I mean, your franchise agreement is 5 years. Some of the brands I work with, it's 20 years. That's a huge commitment, which gives us comfort as well in terms of when we're trying to match the term of a loan against those kind of agreements. You've got that. It's just implied long-term.
And so do you think that, so a franchisee approaches you guys for lending for their business, it's their business. But I guess what you guys are hinting at is that there's an extension to what you consider. It's not just that individual and the business they're starting up in that territory, but rather the wider brand, the expertise that they have across all of those various departments. Do you look at historical failure rates when you consider a certain brand? Like, are there variations between franchisors?
There's certain brands that we don't work with. That's because of the track record that we have with them. So that's that is an important consideration for us. But we do accept that we do lose money as a bank. But I think it's how does the franchisor react to that? Mm-hmm. Is it because most of the time it's going to be down to franchisee recruitment. So again, what are they doing to improve that? I think it's the hardest thing for franchisors, by the way. I think recruiting franchisees and trying to identify, are they the right person for this brand for the next 5+ years, I think is really difficult. And we put a huge amount of trust in your recruitment processes. So it's not for us if someone's presented to us and they've been through your recruitment process, it's not for us to say whether they're a right or wrong fit for you, because you've done that. The responsibility falls on us is, do we think they're capable of, managing our facility and kind of repaying us? That's what we have to sort of challenge on. Yeah. And I think some franchisees, we've seen that they've had to, in their management teams, they've had to bring people with finance skills into the business because it's been acknowledged that that's a shortfall, for them. And I think there's a lot that the brand can do to support them. But ultimately, if there's a weakness around the finances as they grow and scale, they're going to have to tackle that. Yeah. And I think one of the biggest challenges we see in franchising is, as franchisees grow, building capabilities within that senior management team is something that we see as a real challenge. You've got to be really bold to front load that investment. Yeah. I think a lot of franchisees prefer to build it and then add in those capabilities, and it's not always the right way to go about it. And how do you, throughout the recruitment process for franchisees, keep the banks in mind? So, what Marc's just got out there is we need to be really careful with who we recruit so that they, meet the expectations and effectively your criteria. How do you keep that in mind? So, we talk regularly with HSBC and the other banks, but it's really important to take their feedback on board. So our recruitment process with a prospective franchisee is obviously through us, but we also take into account the feedback from our existing franchisees that we introduce them to, the banks, other suppliers that we may be introducing them to, and we take that really seriously. And if there are warning signs along this process, then that is an indication for us that we perhaps need to stop this journey. Yeah. And I suppose that throughout that, there's a process where we look at the financials of the business and their understanding of what that means. Yeah. So for new or for resale, we will go through with that individual franchisee and go through like a financial plan with them. And we're not doing it for them. We're making sure they understand our template and how that works. And particularly with a resale, we're making sure they understand how the formulas fit and how you can use our profit and loss template versus the accounts they've been supplied to by the selling franchisee. So they can understand how to work that. But the bank's feedback and that experience then shapes whether they can do this or whether we need to look at something else or perhaps front load in some training or some support in different areas that they would need. Yeah, because I think our approval rate's really high, for the brand. And I think mostly I can't think of a transaction that we've had decline because most of the time we will be, I guess, intervening early on in the process. One of the main issues sometimes we see is that, particularly with resales, that the person buying needs to take quite a high salary to fund their own sort of living costs. And sometimes when you add that in, plus then the servicing the new loan, they're not quite generating enough cash. And that's typically where we'll have to go back and say, look, this doesn't quite work. You're not generating enough debt, enough cash to service the debts here. So we kind of try and intervene early in the process. And I think, we've had a few of those conversations where, you end up saying, this isn't going to work. Like, at the amount that you've got to invest, plus the amount you need to borrow, plus what you need to take out, the numbers just don't work.
And the beauty of that is you're doing it in the very beginning.
Yeah.
So it's so reasonable to have those conversations there rather than last minute when funds are due to draw down.
Yeah, and people's hopes are up, and people are all like sort of setting their life up in preparation for this business. Yeah, I can imagine that. Well, that's a letdown really for everyone, for the franchisor brand, for the banks and the franchisee, certainly.
Because I always say when I look at the financials, there's, add in 2 lines, for us as the bank, and that's for new and resales. Add in what you need to take from the business and add in the cost of the loan on a monthly basis. Because that's the 2, we will go straight to those numbers just to check that it all works.
Mm-hmm. So in a situation like that, are there any options for people? Is it as simple as working out a way to draw down a lower salary for yourself,
Yeah, because one of the things we also look at as part of that is we'll ask them to provide a sort of income and expenditure statement, so that you can see what they need to draw personally. And, sometimes, there'll be partner's income to consider into that, but it's really important because, if we've got someone that says they can afford to only take, say, £1,500 a month, and then when you look at that statement, it shows that they need to draw 3, straight away that you've got a huge issue there and I think it's like Imi said, you have to tackle that early. So I think one is, can they reduce the amount that they're drawing? Because in an ideal world, yes, they might want to pay themselves 50,000 and they might be able to get there, but not in the first couple of years. So are there personal savings in the background that can be used to either add more into the transaction to bring down the cost of the loan, or to support them personally through the first probably 12, 18 months?
And an example of that is a franchisee that we had that you guys did actually fund. And he had a lot of outgoings like private schools, car leases, high mortgage, but he could evidence all of that. And it meant him putting in extra cash, but you guys were happy with that because he was putting skin in the game. He was increasing his amount that he was putting towards the franchise.
Right. Yeah. So actually a bigger contribution can help mitigate that.
But on the other side, you've got franchisees who say, well, I want this amount, but they actually have very small monthly outgoings and they're not willing to put anything else in. Well, the banks aren't going to fund a lifestyle so you can go on 3 holidays a year, say, and live a really nice life, but not actually have those outgoings necessary. That would be further down the line when the business can afford it and when you can put in that contribution as well.
I think it's credit to Home Instead on resales as well, because we could fund at 100% in certain,
Oh, can you now?
certain scenarios to multi-unit operators.
Yeah.
But it was actually Home Instead that said, actually, we always want 10% to be put in by the buyers, because we think it's important that they have some commitment.
Yeah.
And they don't try, and they aren't leveraging themselves up too high on bank debt. So I thought that was really...
And joking aside, it's so important that people have that cash, because otherwise you don't have that commitment, you don't have that drive that you need to get this to succeed.
Mm-hmm. So we're talking about a lot of things that might that one might need to consider as they go through this process. Ines, can you help people that are listening understand how they could prepare for something like this? How long does it take to prepare? We touched on things like savings. You touched on things like outgoings and how they can be high and actually limit your ability to borrow. So I guess, generally speaking, someone's thinking about franchising. How can they prepare and put themselves in the best position to actually achieve the funding for that business?
Great question. I think that the best thing they can do is obviously do their due diligence.
Yep.
You know and understand the brand that they're looking to invest in, partner in. Would it be possible for them to go and spend some time with an existing franchisee within that brand? And it's really, really important that they speak with franchisees at different stages of the cycle. So, for example, could they go and speak to somebody who's newly qualified, newly joined in that initial 12 months, and then perhaps maybe speak to somebody who's coming to the end of their franchise agreement, maybe at year 5, for example, and just understand the challenges, the benefits within the brand, so that when they come to the bank, they can evidence to us that they've done their research, their plan is strong, and it's viable.
And so, I mean, that's really, really important advice. And actually, I suppose it helps avoid any surprises along the way. And there's probably a lot of reassurance from speaking to people who have gone through those maybe stressful early years and got out the other side and seen some real success. Just thinking specifically about the someone's personal finances, what could you do to put yourself in the best position, to borrow that money?
I think it's about planning. Take the time to find the right franchisor. There's no need to rush into this. And I think part of that process is thinking about the amount that you've got to add into it. And, an extra year, how much savings could that mean? Because that could mean the difference between going into a less established startup brand versus one that's a bit more established. That difference might mean that you can join a more established brand. So that could be significant in terms of, starting out. I always think take the time with the business plan. I think sometimes one of my observations is that franchisees do a very quick business plan because the franchisor provides so much guidance. And I kind of think that's kind of your dossier for your business. Invest time in it, because when things are becoming challenging, that's a document that you can refer back to and think, what did I think was going to happen when I set out on this journey, particularly the financials as well. Take ownership of the financials, because as you start going through the process, adding the actuals versus your plan, like that should be telling you how you're doing pretty early on in the process. So I think, commit the time to that, because once you start the business, it's going to be very busy, very chaotic, and that is kind of like the source of truth.
That's something you can constantly refer back
something
to.
That you can refer back to
and steer yourself back on track, I suppose. Okay.
Yeah, I think the fear for us is that a business plan just gets stuck in the drawer and forgotten. You need to be referring back to it. And in this day and age with software, AI probably can write a business plan. And we've seen them, and probably just like you guys, we can tell that it's been written by AI. You want it to be personal to you, because if it's something that a computer has written, you've got no connection to that and no drive. But on your point about taking your time, I think that's so important. And we have had prospective franchisees come to us to say, I want to do it now. And we actually don't think they're ready. We can, tell there's a bit of nervousness. And so we say, why don't you come back to us in 6 months, a year? And we have had people come back. They now own successful businesses with us. And I think if you've got a franchisor that is pressuring you to sign the dotted line straight away and you're not sure, that should really be a red flag for you. You want to make sure that it's right and you're not pressured into making that decision.
Yeah, that makes a lot of sense. I think sometimes the initial conversations I have with people who are really interested in joining Home Instead and really excited about buying a franchise, it's normally quite frustrating, I think, for them to hear that maybe our recruitment process can take several months, and in their mind, it's more like an interview process that they want to get out of the way, and then they can really start the work. But I think, Marc, to your point, that actually really is the important bit before you begin, because it's where you speak to existing franchisees. You can ask candid questions and get candid responses, and you can plan your financial strategy and avoid any pitfalls that maybe you otherwise would have potentially ignored. So in a way, it's actually slowing down is the way that you get it right. Okay, that'll be helpful for a lot of people to understand that, and maybe to avoid a misunderstanding that actually the recruitment and the approval process for a franchisor it's slower by design, I think, isn't it?
Yeah.
So we're going to jump into a slightly more technical question, but again, a really, really important one. We'll try and keep it fairly surface level. But what are the finance options available to people? Our discussions have kind of just been like, you approach the bank and you get money and you buy a business. But what actually does that look like?
Well, the obvious one when you think of banking is a loan, isn't it? It would be a commercial business loan, whether that be a fixed or a variable rate. And listen, when we speak to any new franchisee, we'll take all the data that they provide and we'll plug it into the HSBC system. And what that does in turn is it delivers a list of all the suitable lending products that we'll have to facilitate what we're being asked to do.
Yeah.
At that time, we'll explain all that to the applicant, along with the terms and conditions, the key features and benefits, and really what they want to know is how much is this going to cost Ines? So it'd be the fees and any other associated costs. So when you think of banking, you think straight away of commercial, of a loan. Mm-hmm. Of course, the funding requirement may be different. It may be more of a cash flow or a short-term nature. So straight away, the overdraft springs to mind, where we would agree an amount for a specific period of time.
Yeah.
Consistently working with the client to ensure that facility is at the right level. And if we need to extend, and if there's justification to do so, it's something we would be happy, as always, to consider.
Sorry, just to come in on the overdraft, because I think there's a lot of confusion around overdrafts, because we have business plans where franchisees will just say, I want a £50,000, £75,000 overdraft for kind of peace of mind. And when we push back and say, you don't need an overdraft on this business based on the cash flow forecast that you've presented, it can sometimes come across like we're not being supportive. But it's our understanding of the model, because if we know from speaking to you as a franchisor that your franchisee shouldn't need a working capital facility, then again, if you've got a franchisee asking for one in their business plan, you've just got to sense check it and say, I don't think you need this. However, if they do need one, and we have some examples of your clients that have like living care, big invoices that can cause an issue with cash flow, we will 100% be able to support those clients. But it comes with a cash flow that says, this is how long I need it for, this is when it will be repaid from, X, Y, and Z. So it's that understanding. I think we ask more questions, because like I say, we understand the model. And also it's an early warning sign for us. If a franchisee is requesting an overdraft, what's driving that? And also if we agree it for 90 days, because that's what the cash flow said, and it can't be repaid in 90 days, then again, what's happened there? So we need to do a bit more, dig a bit deeper on that to really understand what's sort of happening in that business. So I think overdraft's a really important point.
I think it can be quite scary going to the bank as well. I know prospective franchisees, if it's their first business as well, they're really quite nervous. But the questions that the banks are asking are always to help that individual and make the best decision for them. So the more you're sharing with the banks, the easier the process is for the banks and for them.
And I think the brands have a really important role in that, because it's probable that the franchisee will speak to you first, and you can manage expectations about what the bank will be asking for. So there's no surprises when they come to us and we ask for cash flow, we ask for the latest management information. So I think you can, all three of us working together can really help smooth that process for them.
Yeah. And I guess the more transparency, the better. And, I think occasionally handing over so much information can put a lot of pressure on people when they personally feel it's going to be fine and it'll all go okay. But the more you can reveal and the more you can share, effectively, you've got other people to weigh in and say, you might not have spotted this, but, be mindful of this. And I suppose, you spoke about a £75,000 overdraft. That certainly would give you peace of mind. But the more you borrow, the more at risk your business becomes, right?
Yeah.
Actually puts more pressure on it rather than solving it through the operations of the business instead.
Exactly. And look, and then there's a load of, as I'm sure Ines was going to come on to, a load of other products that we, provide. But, the specifics for your business is it's mainly, a bank account for transactional activity, probably a corporate card for expenses, loan for the, either new territory or resale. And then sometimes, like I say, a small working capital facility. But then in terms of other brands that we work with, there's, we've got global trade and receivables finance, we've got equipment finance, there's a whole, spectrum of products that we provide as a bank.
Ultimately, though, with any funding application, does it make sense? Is it consistent with our expectations for that brand? Credit do not like surprises, and we do not like to give them any opportunity to come back and challenge. So if everything makes sense, we've got a nice clean application, it enhances our chance of approval. And listen, we love franchising at the bank, and we want to support whenever possible.
Yeah, is it fair to say that you would welcome any discussion on lending options? For a variety of problems and aims that people have.
I just like speaking to people, Luke, in all honesty. And, you never know where a conversation will take you. And like I alluded to earlier, we want to help. It's what we do. It's in our DNA. We're a specialist team. And, yeah, we just love franchising, mate.
I think we can all say that around this table, actually.
Definitely.
It's what unites us all. So we've... I think that's important because, certainly to go over the slightly more specific lending options that people have, because it's not just one type of thing. So we've slightly touched on this, but let's put it in kind of a specific answer. Imi, I'll probably start with you here. A potential franchisee comes and inquires with us, the Home Instead, or any other franchise brand out there. When should they expect to meet with the bank? Should they do it immediately or not?
So I think after they've had the discovery day with us or the brand of their choice, where they know more about the operations, they know more about the model, they've seen perhaps a template financial P&L, so they understand what that looks like. And they're probably at the point of speaking to franchisees. So ideally, I'd like them to be speaking to franchisees and speaking to the banks at a similar time. They've got that understanding behind them. If you're speaking to the bank straight away, you don't know enough about the brand to be able to have a confident conversation with the banks.
Yeah.
And if you leave it too late, you then may be setting yourself up for disappointment and you're really far into the process.
Yeah, that's important. Too early and you don't have an informed enough discussion to even get anywhere with you guys, and too late, like you say, you could get a surprise later down the line when you've already committed loads of time. I guess in a way, for people approaching a brand, follow the brand's lead, because they build the relationship with the banks and actually develop the process with all of these things in mind. So don't rush ahead and try and sort it yourself necessarily, because an introduction will be made in a timely way.
Sometimes I think, though, introducing us early can help in terms of that reassurance piece. Because I think concerns about access to funding, I think, is a real barrier for why some people don't take the final step.
Yeah.
They're concerned with my, either with the cash that I've got or with the amount of equity in my home, would I be able to get a loan? And some people just convince themselves that they won't be able to. I think sometimes speaking to us early in the process, we can either provide that reassurance or kind of say to them, look, it's going to be really difficult based on your current, situation and the amount of cash that you've got to invest in this brand. But it doesn't mean that there's not other franchise opportunities out there for you. So I think that's, we can
really
help
true.
that,
Yeah, if you're in that mindset, I think speak to the banks immediately. Sorry, I just went for the kind of standard prospective franchisee who's got that cash and is ready. But yeah, if you've got those questions and concerns, definitely speak to the banks as soon as possible.
Yeah, and we also, like a lot of franchisees will approach me and say, particularly existing operators will say, which brands are up and coming? So, I think a sector specialist team like us, like we have insight of that, of like what's I guess coming down the track.
Yeah.
What other brands might be, exciting. So again, engaging with us on that subject is a good starting point as well.
Yeah, you can give kind of an outside perspective rather than hearing it from the brands themselves. Yeah, that's really important. So I've kind of I'm putting myself in the shoes of someone who knows they want to do this. They know they want to approach a franchise brand, and franchising is definitely something they're going towards. But they've got minimal savings. Is it a hard no, and actually the focus should be on building some savings towards it? Let's kind of explain that for people.
I think it would be a soft no.
I don't mean a no in an aggressive way, but sort of.
I'm not going to hit them over the head. But I think it's about managing the client's expectations here and explaining to them, listen, if we're going to do a deal, this is what it's going to have to look like.
Yeah.
In terms of, and listen, cash is king, and I sympathise with a lot of franchisees because it's not everybody that has the sufficient cash.
Yeah.
to bring to the table, but it's so important to manage expectations here right from the outset, so that the client may be able to go away in 6 months, 9 months, 12 months time. They could come back with a nice, clean, viable plan, and we could take things forward.
Or it might be that you invest in a smaller franchisor in a completely different sector, invest your small amount of money in that, build up the business, and then have that dream brand in your mind for 5-10 years down the line when you can join that business, when you can afford it.
And become a multi-brand operator.
But I think you're a great example of where there's flexibility with your model as well, isn't there? Like, you get some people that their heart is set on a resale opportunity, and sometimes the right resale can be quite expensive for them, but you have the new territories that they could look to. So if they really want to get into a brand, there's different entry points. Now, there's a lot of brands out there where that's not the case. So your only entry point is maybe a resale of a larger group, so you're never going to be able to enter that brand. So I think you offer a flexible entry point.
Yeah, and I think that's ultimately where approaching brands and understanding what costs are associated with this will help you understand if it's right or wrong for you, or actually if maybe the timing's wrong. So yeah, I think that's a really useful thing to go into for people, because it can be quite a mysterious part of the process for people.
I think it's trying to narrow down the sector as well. I think so, like franchising, there's so many brands out there. I think if your heart is set on domiciliary care, that's a great starting point. Yeah. Because then you can start to narrow it down from the brands that are, that specialise in that area. Or if it's quick service restaurants, again, you can sort of narrow your focus a bit, because otherwise it's a bit like trying to boil the ocean.
Yeah, that makes a lot of sense. So what might the reasons be, other than, there's not enough cash to even begin the lending process? What might the reasons be for a loan application to be rejected? So those situations we spoke about where you get a little bit later down the line and actually, unfortunately, it can't go ahead. Can we go into that a little bit? Yeah,
well, Marc mentioned it a little bit earlier about credit scoring. We'll typically credit score the director or directors of the business. Now, unfortunately, there are instances where the credit score is of a level where we can't support. Now, credit reports are often very hard to repair and are timely to repair. So that's a classic example of an application where we may have to take a step back from. Other things that would prevent an application from progressing could be something as simple as that there's a large part of information missing from within the business plan that doesn't give me as a franchise director or one of my credit colleagues the comfort to be able to assess that application correctly. Business plans they come in all different shapes and sizes. Sometimes less is more. Some applicants will submit the Argos catalogue to you, and it's a heavy read. So to move slightly off subject again, the importance of the business plan is absolutely key to any lender when assessing the opportunity. Again, we touched on it earlier. We used the word EBITDA and debt servicing. Again, we have to be comfortable as a lender that the business is generating enough cash to meet its obligations. And how we do that is we'll assess the financial information. So quite often, particularly with a startup scenario, we're actually asking the customer to get a crystal ball out and project 3 years into the future. Yeah. And we need to make sure that there is sufficient cash within that business to service the debt. Because if we don't, look, we could be setting somebody up for failure. And that's not what we're looking to do.
And Amy, from your perspective, is that, let's say someone approaches the brand and maybe they've never put a business plan together, but they definitely feel they can, and they maybe have a really good understanding of the industry they're joining, and for a variety of reasons they seem like a fantastic franchisee, but perhaps they give you the single sheet of paper that you described rather than the Argos
fag packet
rather than the Argos catalogue. Are there things that the franchisor can do to support, not necessarily to write it for them, but to give them another go at that?
Yeah, definitely. So we don't want to write the business plan for our franchisees. We have a template, which hopefully isn't too full of information. As Marc mentioned, other brands, it can be. And And people can choose to use that. I've seen people want to go off and do their own thing, which is absolutely fine. We would always really want to have a look at it before it goes to the banks, just to do that sense check and say, maybe you need to talk a little bit more about here. So it's almost like the first check before it goes to the bank. But definitely ask questions. And Ines mentioned before about projecting over the first 3 years. Speak to the franchisor and see actually what would a typical projection be like for those 3 years, because they can answer those questions for you.
Yeah.
And then speak to the franchisees as well that you were introduced to as well, to sense check through them too.
I think it's the most important point. I think the numbers, the franchisee, it's a really difficult area because, a franchisee probably isn't experienced around forecasting and all that kind of stuff. So the brand has to provide some sort of guidance, but ultimately the franchisee has to own those numbers. Yeah. So it's down to them to deliver. It's their business. And yes, the brand provides guidance and will, provide support. But that's their numbers, that's their sort of business plan. And I think also encouraging them to sensitize it, because we will sensitize it as a bank when it comes into us, because we'll look, what if sales drop 10%? What if gross margin drops 3%? What if base rate increases? Are they doing their own stress testing of those numbers just to be sure that it's, achievable? And I think it takes a huge amount of pressure off as well. If you know that it works, given some of those, say, unfavourable conditions, and you can still afford to pay yourself a salary and service your debt, then that gives you a huge amount of peace of mind going into it.
I think if you're also getting the projections from the franchisor, ask what that's based on. Yeah. So ours are modest average projections. If you've got a franchisor that's basing it on their fastest growing business ever, then that's not probably going to be as feasible for you. Yeah. So you want to make sure it's realistic.
It's one of the biggest challenges we face when we speak to new brands is that, that financial model, that proof of concept piece. And I think it's really difficult. There's a lot of brands that we speak to that are performing really well in London and then looking to franchise in the regions. We're like, but how's that going to look in the regions once you step outside of London? London's it's almost its own, its own sort of, what am I trying to say?
Country.
Not country.
Micro market.
Economy.
Ecosystem.
Yes, that's it. Ecosystem, economy, all of those things, just because it works in London doesn't necessarily mean that it will, transfer to the region. So again, what assumptions are you making on your franchise model as you start to expand outside of London?
And I think prospective franchisees are scared of giving modest projections to the banks. I think they think, no, I need to look like a really great candidate that can grow this business really quickly. Yeah. If you want those projections for you to personally achieve privately, absolutely great, keep that for yourself, but show the banks that real modest, safe, stable projection.
Yeah, and look, has to work conservatively.
Yeah,
but I think there is. I think it's a really good point. But I think there's definitely a happy medium here, because sometimes you get presented with numbers that are just too conservative.
Okay,
and it's like, well, if you're going to buy this business and you're saying that all those bad things are going to happen to it, then that's too conservative, and we can't fund against that, because you're showing that you're not going to have enough cash to service the debt. So there's definitely like a sort of middle ground that is, that just treads the line between the two. I think I'd encourage everyone to move away from 3 sets of forecasts, one for your accountant, one for the bank, one for the franchisor. That's not what sort of this is about. This is just about a really, well thought out set of financials that you're confident that, you can achieve. And if you do achieve them, then you can, like I say, pay yourself, afford to repay any sort of bank debt.
I mean, it goes back to what we were saying before, that taking your time through that process to really get that plan right is it's going to help for every step that you take beyond that, isn't it? So before we kind of close out, I'm gonna ask a question about what happens when it doesn't go right. So someone has an application accepted, they join a franchise brand, and for whatever reason, their business isn't taking off. What happens to the borrower?
That's a really good question. I'm trying to think. There's loads of different scenarios. I think first and foremost, what we would look to is what support is the franchisor providing. That's the most important first step in the process here. So we will probably have early warning signs. We will probably be made aware that things have become a bit challenging. Maybe there's a request for an overdraft increase. Maybe there's a missed loan repayment. There's loads of things that we will observe. Or maybe it's the quarterly management information is late, or when it comes in, it shows that it's not in line with the projection. So there's loads of things that we will observe, and we'll start having the conversation around the support that we can provide. And then I think it's about all of us working together.
Yeah.
I think, McDonald's talk a lot about the three-legged stool approach. And I think it's when things are starting to go wrong that you really see the benefit of that. So, there's support that we can provide as a bank, but there's certainly support that the franchisor can, provide as well. And that's what we just be keen to understand. What is everyone trying to do here between franchisor and the bank? What is everyone trying to do to course correct, basically?
Yeah. Well, I mean, I was gonna come on and ask you what we do to mitigate all of those things from the franchisor's perspective. But I guess, we've spoken about the benefits of lending and the opportunities it can open up. But I think it's important for us to set the whole scene for people. Yeah. What is the worst case scenario? And then Imi, I'll come to you and ask how we avoid that worst case scenario for anyone. So can we start with so the three-legged approach for not Home Instead, but some brand, it doesn't go right and someone's borrowed a load of money. What happens to them personally, I guess is what I'm asking.
Look, I think it depends, the position that they've put themselves in terms of, security. But, we're a responsible lender. We're gonna work with them to take steps to try and find the best course of action for them.
Yeah.
So I think there's no knee-jerk reaction from a bank like, HSBC. We do lose money. It's a fact of banking. And like I say, we'll react in a responsible way. So I wouldn't try and scaremonger people. Like, we hope that it won't happen, and that's why I think for me it's more important to talk about the intervention that takes place.
Yeah, absolutely.
Because we don't lose a huge amount of money in sort of franchising, and to be honest, most of the times, because of the certainly some of the large brands that I work with, the confidence we have in the brands, we don't take a huge amount of personal security. There's a lot of brand lending that takes place, so there's not a huge amount at stake to those individuals other than, the business that, the business itself. And that's not to kind of diminish that. But, in terms of personal collateral that's at risk, there's not a huge amount normally. So I think we try and just focus on, how can we all work together, to avoid it getting to that, to that position. And there's a number of things that the brands do as well. Some brands will take over the running of that, particularly in the quick service restaurant space. They'll take over the running of that restaurant if they have the ability to do that, and that can help mitigate some of the losses that we would face. Other brands, that's a bit more challenging if they don't have the corporate structure and the means to sort of do that. But like I say, I think it's just about us all working together, really.
Yeah, absolutely.
Because it's like understanding the reasons as well.
Yeah.
Because if a franchisee is doing everything right, then all of us would be extremely sympathetic to that individual. That maybe something just hasn't quite worked in that territory for some reason that none of us could have seen. So how can you get them into a better territory or a different opportunity?
I think what's really important in these scenarios is that the client continues to engage with the bank.
Yes,
because what we often see is they bury their head in the sand, they'll become unresponsive and just hope this goes away. Now, it's not going to go away, and prevention is better than cure. And if we can all sit round the table, bank, franchisee, franchisor, reassess the situation. Why have we got here? Can we can we improve? Can we put something in place to trade out of it and get back to health? It's often like, they're in the intensive care ward. So how do we get them back into the normal ward and then get them discharged and back trading again?
Yeah.
It all comes down, and I'm going to use the word again, relationship, and just please, you must continually engage with the bank and speak to us, because if you don't, we can't
just gets
help.
harder, doesn't it?
We can't help. Yeah. And
well, and that's exactly what I was looking for with that question, effectively. And it's not to scaremonger whatsoever, but more to anyone borrows any amount of money, there's a feeling of pressure on you, and certainly from someone who goes from not owning a business to borrowing a substantial amount to start one up, there'll be a feeling of pressure. So from your answer, I'm glad that there's an element of reassurance and actually a structure of support around people to avoid that happening at all.
Yeah.
And more practically, Imi, from our perspective and generally franchise brands perspective, what can we do to support people to identify it early and then avoid any issue like that?
I think for us as well, we've got the really good relationships with the banks. So if there are signs...
Did you say banks, plural?
I did. I am afraid there's more than one bank that funds. I'm sorry, Marc.
I think Emmy's maybe referring to some of our down market rivals there, Marc.
I didn't realise there's other franchise banks. Anyway, sorry, digress.
Do your research, listeners. Find the right bank for you.
Other banks are available.
I have been saying banks the entire time.
That's the first time I picked up on it.
Oh, right, okay.
Okay, sorry.
It's okay. I think the beauty of having good relationships with banks is that we will be aware of things going on in the background. But as Ines said, it's all about the relationship. We want people to come to us when they are starting to see the signs of struggling. Now, as soon as we see the signs externally, so through the revenue coming through or whatever it might be, we will immediately be reaching out and really putting that arm around that person. And it might be additional support. So we're sending out somebody to go and visit them. We're having weekly or bi-weekly or monthly calls to go through their financials, make sure they feel really comfortable. We'll be talking about their conversion rates, what are they doing to attract more clients, etc. So we really throw everything at it to make sure that someone can make a success of it. But that is also making sure that they actually do that as well. So I think that the three-legged approach with us having really good relationships means that we can act very, very quickly. And that franchisee needs to step up and say, actually, I do need some help, and we've got people who are fantastic successes and they've had tough times. Everybody does. It's the way you work through that tough time, I think, adds to your success.
Yeah, I mean, more experience, right?
It builds on the on the three-legged stool as well. It's you find out a lot when things are difficult.
Yeah.
I think it's in a buoyant macro environment, it's easier for us to lend money. I think when things get a bit challenging, like it has been the last few years, you really see the supportive franchisors that have been helping to try and maintain some element of status quo in their systems. And I think that's like I say, I think you do learn an awful lot in the difficult times.
Yeah, and listen, there could be a number of reasons. People are vulnerable out there, and they may have lost a loved one. They may be going through some really, really hard times, and you got to be sympathetic to that. And like I said, it's tough, but we can help.
Yeah.
We want to help, but yeah, you never know what's under that cover really until you speak to somebody.
Yeah, and I guess it's a huge benefit of going the franchising route generally, that actually there's safety nets around you and other people that are thinking about your success as well as yours. So, for anyone that is thinking, I really want to take this step, but borrowing all that money just sounds scary and I don't want to put my family at risk, I don't want to put my home at risk, but actually the risk is substantially minimized by having the three-legged stool, the support and the safety net and other people watching and caring about your business as well. Yeah, thank you guys.
Are you going to turn the tables on him?
Yeah, a little bit of role reversal here, Luke and Emmy. Is there still a perception in the marketplace that banks are not open for business and lending money? Do you see that as a challenge when speaking to franchisees, an objection?
So I see people further down the line than you do, Luke. So do you want to go first?
I guess from the majority of conversations I have are either with people who already know how it all works and maybe they've actually got their own previous relationships with banks and lenders, so they actually don't necessarily want to hear my advice on it, or the complete opposite, where people kind of launch in with the question of how do I even pay for this? Because I see on the website the total investment is 150k. Does that mean I need 150k in cash? I've got nowhere near that. And actually, my job really is to help them understand that lending is an option, and it does not require 100% of that investment. And in our situation, it requires 30%. So I don't really have too much of an answer on that beyond, I think people generally want to know it is an option. And I think it would be Imi that sort of can answer that a bit more.
So I actually don't see people thinking that banks can't lend. I really don't see that at all. I think I see people who are not wanting to speak to banks straight away, and they want to push it further down the line, which I kind of encourage them to talk to you as soon as possible.
Yep.
You can't be too pushy though. But I will say, you guys were so flexible through lockdown, through the pandemic. You really, really were such a supportive bank through that period of time. And our experience of that and our franchisees have been that you guys were incredible. And any conversation that I have with prospective franchisees is that banks can help, banks can lend. So I don't seem to get that at all.
That's great to hear. From a funding perspective, it's good to know, because we're most definitely open for business, and we're keen to speak to as many prospective new franchisees as possible.
Well, there's a symbiosis to the whole thing at the end of the day, that it's part of our message to the world that this is an option for people.
Yep.
Particularly as you get into the higher end resales and stuff, where actually you're talking about hundreds of thousands needed in cash, that's not attainable to everyone. Certainly not the asking price of £1 million business. So it's really important for us to spread the message that we have strong relationships with the banks who are willing to help people. And there's a variety of options for specific needs. That's certainly something that we put out there and make sure that people know.
I always think selecting the brand is the hardest part, the hardest step in the process. I think once you've selected the brand, then, the kind of, the lending and the banking bit kind of, takes care of itself, really.
Yeah, absolutely. Thanks for the question there, Ines. The role reversal. The table just flipped. So we're pretty much done, guys. Thank you all very much. I think that this definitely is a confusing part of the process for people that have never come across that. And so I hope that anyone sort of listening or watching can take some things from that, and certainly some reassurance that there's people all surrounding this entire process that are there to support you and help you through that, and actually that this is an option for people to take that next step into franchising.
And if people do have questions and they want to speak to Marc or Ines, how would they get in touch with you guys?
Drop me an email, ines.j.laing@hsbc.com, or they can use the generic franchise team email at HSBC, which is franchiseunit@hsbc.com. Or if you're ever up in Glasgow, just pop in and see me.
That's like an ad reel at the end of our podcast.
It was.
I won't give my email address; it's far too long. But you can contact Home instead. They've got my details, or look me up on LinkedIn.
Yeah, I'll make sure as well in the description of the podcast episodes put some information in so people can follow that through.
Perfect.
So thank you so much, guys. I think that's been really, really helpful.
Thank you.
Thanks both.